Central banks like the Federal Reserve in the US and the Bank of Canada keep talking about rising interest rates and how they have to rise to cool inflation, but they aren't talking about what really has to happen for inflation to come down. And if you're one of those people who's hoping for higher interest rates and a crashing real estate market, well, be careful what you wish for, because rising interest rates, lower inflation, and a cooling real estate market could have a greater impact on you than what you might expect. But before we get into it, do me that favor and hit the subscribe button. If you are somebody who is looking to thrive financially, well, you are in the right place. So go ahead and click that notification bell as well. Okay, so everybody is watching inflation right now and hoping that those inflation numbers start to creep down, so hopefully interest rates stop going up. But those aren't necessarily the numbers that people should be watching. Inflation isn't necessarily the lead indicator here. There's another stat that the Bank of Canada and the Federal Reserve in the US have stopped talking about a long time ago, even though it was a primary topic during the pandemic, and that is the unemployment rates. Do you remember this? Do you remember that the Bank of Canada, the Federal Reserve in the US, they kept talking about the fact that they weren't going to start increasing interest rates until we got to full employment. And lo and behold, here we are at full employment, and we've got significant amounts of inflation in the economy. Now, yes, some of that has to do with supply chain issues and all the things that came along with the pandemic, but one of the biggest issues in our economy is too many people are employed. And it turns out that there is an inverse correlation between inflation and employment. It's not just interest rates that have an effect on inflation. It's actually that increasing interest rates has an impact on employment, and then employment has an impact on inflation. And this is a relationship in economics that we call the Phillips curve. Now, the Phillips curve doesn't always work, but the majority of the time it does. And what the Phillips curve suggests is that there's an inverse relationship between unemployment and inflation. So in other words, when there's high unemployment, there's low inflation. And when there's low unemployment, there's high inflation. And this makes sense, right? When there are less people unemployed, there's more money in the economy, which means prices will go up. And when there are more people who are unemployed, there's less money in the economy, which means prices will come down. So right now we're in this place where we've got really low unemployment, like the lowest rates in history. And in order for inflation to cool off, what the central banks are looking for, what they likely need to happen, is for unemployment to go up drastically. Because taking a certain percentage of people's incomes or their money out of their pockets isn't going to be enough. What likely needs to happen in order for inflation to come down is there needs to be a higher percentage of people who are unemployed and therefore don't have jobs and can't borrow anymore and can't actually spend the extra money, so that there's enough downward pressure on the economy in order for inflation to start going down. So it isn't necessarily the act of having higher interest rates that lowers inflation. It's the act of having higher interest rates that create unemployment that lowers inflation. Now, in order to illustrate this, I've pulled up a few different examples of the Phillips curve and basically inflation versus unemployment. So I'm going to jump you in here, take you a look at our screen. And what you can see is this is really a simple graph. It's inflation versus unemployment. Inflation's the blue line and unemployment's the red line. And this is for the US. I'll show you Canada in a minute because it backs up this theory. And what you can see is that anytime that inflation is coming down, unemployment is going up. 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 And this rings pretty much true for most times, especially during recessions. And if you want to take a look at Canada's numbers and Canada's graph, it looks very similar. So if I take myself out of here so that you can see it, again, you see this inverse relationship. In this graph, inflation is the red line and the blue line is the jobless rate or unemployment. And in addition, on this particular graph, you can see the gray areas. The gray areas indicate recessions. And what you can see once again is you have inflation coming down as unemployment goes up. 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 And this rings pretty true throughout the economy during any recession and during any high inflationary period. In order to have those inflation numbers come down, you have to have unemployment increase. It's not enough just to take a little bit of money out of everybody's pockets. You need to actually have some people who end up losing their jobs. So this is why I say be careful what you wish for when you're wishing for higher interest rates in a crashing real estate market, because you are actually hoping that a significant amount of people will end up unemployed. And in addition to that, because people flow in and out of the job market, it won't just be an additional 5% of people who find themselves unemployed. It will actually be a higher number than that, as some people enter back into the market as others leave. So we're actually hoping, when we hope for higher interest rates and a crashing real estate market, we're hoping for higher levels of unemployment, which means that you could very likely find yourself in a situation where you are unemployed. And with a recession looming in the near future here, what will end up happening is businesses will have less growth. Therefore, they'll probably start eliminating employees. to increase profits, especially in publicly traded companies. And at that time, we're going to start to see unemployment rates start to rise. That will eventually lead to lower inflation. Hopefully, we'll have some supply chain issues that sort themselves out so those inflation numbers don't get super high. But this is potentially a huge problem that we could have in the new year. And one thing I want to point out as well, I'm going to jump back into the screen here, is anytime that employment starts to go up, so whether it starts to go up here, 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 or here, if it starts to go up a little bit, it tends to go up a lot. There are very few times where unemployment levels are flat. They're either increasing substantially or decreasing substantially. And I suspect that in the coming recession that we're headed towards, inevitably, because of the higher interest rates, we are going to see jobless rates that are significantly higher than what we've seen over the last 2 years. So what do you do to prepare for higher interest rates? Well, first and foremost, you need to be saving every penny that you can. Second of all, make yourself super valuable to your employers. Make sure that you're going to be the last one let go, not the first one let go. And in general, just make sure that you are spending far less than you are making. So I hope you found this video useful. If you did, do me a favor, hit that subscribe button. You can also check out other really useful videos here. We'll see you on the very next one. Cheers.